Imagine this. The year is 1637. Tulips, yes, the flowers, are worth more than houses. At the height of this craze in the Netherlands, people sold land, borrowed money, and risked fortunes just to buy rare tulip bulbs. And then, almost overnight, prices collapsed. This was the world's first recorded stock market crash, known as Tulip Mania. Today, we're going to explore what happened, why it happened, and how this bizarre flower frenzy shaped the values and behaviors of the financial markets we know today. To understand Tulip Mania, we need to look at the backdrop. The 1600s in the Netherlands was a period known as the Dutch Golden Age. The Dutch were becoming a global economic powerhouse, with thriving trade networks, advanced banking systems, and rising wealth among merchants and the middle class. At the same time, tulips had just been introduced to Europe from the Ottoman Empire. Their bright colors and unique varieties made them a status symbol. Some bulbs were incredibly rare, with unique stripes caused by a plant virus. Soon, owning tulips wasn't just about gardening. It was about prestige, profit, and speculation. As demand grew, tulips became one of the earliest forms of what we might call a futures market. People weren't just buying bulbs, they were signing contracts to buy or sell them at future dates, hoping prices would keep rising. Prices skyrocketed. A single rare bulb could sell for as much as 10 times the annual income of a skilled worker. In modern terms, it's like paying millions of dollars for one flower. But here's the problem. Prices weren't based on real value. They were based on belief. The belief that someone else would pay more tomorrow. And once doubts crept in, the system cracked. In early 1637, confidence collapsed. Buyers vanished. Within weeks, tulip prices plummeted by over 90%. Imagine thinking you owned a fortune in flowers, only to discover your investments were now worthless. Contracts went unpaid. People who had borrowed money to speculate were ruined. Although not everyone in the Netherlands was directly involved, the psychological shock was huge. It revealed, for the first time in history, the devastating effects of a speculative bubble bursting. Interestingly, the Dutch economy itself didn't collapse. The financial system was strong enough to withstand the fallout. But for individuals who had gambled everything, it was a disaster. Trust in speculative contracts was damaged, and the government had to step in to settle disputes. More importantly, Tulip Mania became a cautionary tale. It forced people to start asking, what gives something value? Is it rarity, utility, or just the belief that someone else will pay more? The tulip crash set the stage for how we think about markets today. Here are some of the big lessons. Speculative bubbles can form anywhere. It doesn't matter if it's flowers, land, tech stocks, or cryptocurrency. When prices rise only because people expect them to rise, a bubble is forming. Human psychology drives markets. Fear of missing out, greed, and herd behavior played as big a role in 1637 as they do in modern crashes. From the Great Depression in 1929 to the dot-com bubble of the 1990s, the need for regulation and transparency, Tulip Mania highlighted the risks of unregulated markets. Over centuries, governments introduced rules, oversight, and financial institutions to prevent chaos. Though bubbles still happen, perception versus intrinsic value. Tulip Mania made clear that markets aren't just about physical goods, they're about belief, trust, and perception, which remain at the core of stock market behavior today. So, what did the first stock market crash teach us? That markets are not purely rational machines. They're deeply human, vulnerable to our hopes and fears. From tulips in the 1600s to housing in 2008 or crypto in recent years. The same cycle repeats. Excitement, speculation, overconfidence, collapse, and lessons learned. At least until the next bubble. Tulip Mania wasn't just about flowers. It was about the roots of modern finance. And it continues to remind us that behind every number on a stock ticker lies human behavior.